Yo, what's going on? Welcome to Chart Patterns. And in this video, we're going to be discussing price gaps. Okay. A price gap is an area in the chart where shares have not traded during market hours. If you're looking at a daily chart, you'll see price close at one level and then open at another level. It might open higher or it might open lower. So that space in between is considered the price gap. Now, I use price gaps all the time in my charts to have an idea of where price might be heading to next. All right, so it's important to understand that not all gaps are created equally. Some gaps are considered common gaps. Others are breakaways, runaway, or exhaustion gaps. So there's a couple different variations, and it depends on where it happens in the chart, as well as the volume, which is the amount of shares that are traded during that gap, and where it is in relation to the overall trend of the stock. And so I'm going to link some articles in the description below to investopedia.com, which is a really good resource. I use it all the time to get definitions and just to brush up on some information. All right, so the first example we're going to take a look at are common gaps, and we're going to use Tesla for that because Tesla's had a lot of really good examples in the last couple of weeks. So let's dive right into that. I'm going to show you how to find the price gap and then how to mark out the levels so that you can be aware of those areas. So what I typically use is a horizontal ray, which is basically just a horizontal line. So you can use that on any platform, but you want to make sure when you are charting those levels that you're using a magnet on your charting software, which is going to magnetize the line to the particular level that you're looking at. So you don't want to be eyeballing stuff. You want to have exact levels on your chart. So let me show you an example. Over here on TradingView, I have a magnet, which is on, and then I click my horizontal ray. So when I'm moving my mouse around to these different candlesticks, you can see that the crosshair is kind of snapping in to different areas. So this is going to snap into either the open, the high, the low, or the close of day, depending on where I move it. But it's always going to snap into one of these levels based on where I put my cursor in. If I turn the magnet off, then it's basically just me trying to find the exact level and then trying to mark it, perfectly at that level. So you don't want that. You want to make sure that you have your magnet on so that these levels are completely accurate. So just to reiterate this, price gaps are formed when price closes at a certain level and then it opens above or below that area. And that forms a price gap. So I marked the chart up with some arrows on some price gaps that I noticed. Some are really small. Some you can't really notice as much until you really dig into it. What I'll do is I'll zoom in a little bit more on these areas so we can see them better. So you can clearly see here, there's a gap there, a gap here, another gap here, and then there's another gap right here. Again, it's based on where price closes. So price closed right here, and then it opened over here. So this area, this zone right here is a price gap. So we're gonna look at that one. Another one over here, price closed here, and it opened over here. So this area is a price gap as well. So it's important to understand what the candlesticks represent, or else this is going to be harder to understand. I do have a video on how to read candlesticks. So if you're at that level, you want to start with that first before you start diving into this stuff. We're going to start getting into the charts. Okay, let's get into the fun stuff. So let's point out some of the obvious gaps here. So one of the most obvious gaps is right here. So we closed at 656.57 and we opened at 674.99. So that's a pretty wide gap, about $20 or so, give or take. So here you can see on the chart that there are no shares that were traded from this day to this day. So that's the price gap right there. Goes from the close to the open. All right. So that's one price gap right here. Let's do this one. This one's a little smaller. We closed right here and then Tesla opened right here. One of the first things that you want to keep in mind is that these common gaps tend to come back into that range and what's called fill the gap. So if we look at this gap right here, Tesla went up, so it gapped up, and then it gapped up for a second day. So it left two gaps behind. So this gap is a pretty large gap. And so it took 7 to 8 days before price came back into this gap. So you can see here, that's the gap, and then price goes back into that range. So right here, you'd consider the gap to be filled. Now at this point, you'd probably be looking at the next gap below, which is in this range right here. And that's exactly what we did. price came right into this gap and then it rocketed out of there. So it hit a low of 620.46 and it actually made a high of 654.43. So this was a $34 move from the low, which coincides with that gap fill. So this is one example of a common gap. And I tend to see these a lot on stocks like Tesla because they tend to be very volatile. And one day, they'll open up higher, some days they'll open up lower. And depending on whether there was actually any significant news driving that, then it's called a common gap. So if there wasn't anything significant, it's a common gap. And the chances of it coming back into that gap are very high. So I really love to keep an eye on these price gaps, especially on a stock like Tesla. So now that we looked at those two examples, let's clear these out and we'll look at another example on Tesla here. So we'll move to the right a little bit. There's actually a gap right here. So it's a little smaller, but you closed right here at 656.95 and then we opened at 662.20. So it was about a $6 gap or so right here. All right, so you can see, again, there's no shares that were traded in between those 2 days. All right, so what happened? Price went up and it came back down and it filled the gap. This one only took 2 days and it filled the gap there. And then the price actually came back into this low area, which coincides with that gap. So price had to come back, retest that level, and it went higher from there. So this right here was another example of a common gap getting filled. So let's remove that from the chart. Here's another really good example. Tesla closed at 687.20 and then it opened up at 700. So you got a $13 gap here, big move, and then it took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days for Tesla to come back into that price gap. All right, so again, the price gap is from where the price closes to where it opens. So this is the gap right there. Filled the gap, took 10 days, so about 2 weeks, and we ended up filling that gap. So, there's more examples here, like this one right here. You could see that this eventually filled there. So honestly, for me, this is probably one of the most reliable setups and one of my bread and butter ways of figuring out where the potential is for price to go next. So this is common gaps. So now we're going to take a look at some other forms of gaps on our next examples. All right, so the next two examples we're going to be looking at are called breakaway gaps and runaway gaps. Now, contrary to the common gaps that we just looked at on Tesla, runaway gaps and breakaway gaps don't always come back to fill. Where we saw on Tesla, price would gap up, it would come back down, or it would gap down and come back up. Those are the common gaps, all right? These types of gaps don't necessarily have to fill. So it's really interesting because we're going to take a look at that now on AMD. All right, so how do we actually determine the difference between a common gap and a breakaway gap or a runaway gap? Here's what Investopedia says. Runaway gaps and breakaway gaps tend to happen on higher than normal volume. So whereas a common gap, you're not seeing any additional spikes in volume, which is the amount of shares traded. On the breakaway gaps, you're going to notice a much higher than average amount of shares being traded. You're going to see the volume bars spiking and you're going to see price moving in a certain direction. So that's one way to tell whether it's a breakaway gap or a common gap. So let's take a look at the chart and we're going to break that down now. All right, so in this example, we're looking at a breakaway gap, which turns into a runaway gap. And so one of the things that I just mentioned was the volume. So if we look at the volume bars at the bottom of the chart right here, you can see that there's a volume increase in this area. Volume increases into this breakaway gap. And then there's an earnings report on July 28th or so. And then AMD gaps up again, which was called the runaway gap. So the first gap is the breakaway. And the breakaway happens again on higher than average volume, but it also usually happens while the stock is already in an uptrend. So AMD is still uptrending, and at some point price breaks out of a range. All right, so this is pretty much a range right here that it was trading in. And then you have price breaking out of that range and it creates a gap. Now that gap again is on higher than average volume. So that tells you that there's more strength behind the move. Now you don't immediately know that this is going to be a breakaway gap. you have to actually watch the price action afterwards because it can fail. So a runaway gap is basically when investor and trader sentiment changes and people are just rushing to get into the stock and they don't care what price they're paying because they see that the stock is likely going to move higher. So based on their earnings reports and other factors, forecasts and things like that. So you have here the initial breakaway gap on the higher than average volume, which happened before the earnings call. And then once the earnings call hit, it posted another breakaway gap and it started to trade above this area. Now, if we look at price action and we fast forward, because this was July of 2020. So if we fast forward into time a little bit and we look at where the runaway gap and the breakaway gap started and we draw a line across here, you're going to see these areas have not actually been revisited. So if we look here over in May of 2021, it broke slightly into this range, but it didn't come all the way down to fill the gap completely. And as a result, AMD has been in a continued uptrend. So this is a really good example of how these runaway gaps and breakaway gaps don't necessarily have to come back and fill that price action. And again, one of the tells is the big volume increase. So it's on above average volume, and it's usually on earnings reports or other significant news on the stock. So I really like this example because it's not like the Tesla plays where you're just trading on average volume. So if you look here at the bottom, if we're looking at the volume bars, there's no significant spikes in volume here. All right, there's one right here a little bit, but it's not significant. Now, when you compare it to AMD, you can see here that there's multiple days of volume increases. And these spikes, if you look to the left here at about the average volume, right? I'm just drawing a line here. That's not the actual average, but you can see that these volume spikes are very large. So if you were trading this just like you would the Tesla gap and saying, oh, it's going to come right back into that gap, then you would have gotten burned on that because it never came back to the gap and you'd still be waiting well over a year now later. So really good example on breakaway gaps and runaway gaps. All right, so the last example is called the exhaustion gap. And by now you might be exhausted. We're 13 minutes in, but stick with me. And this is going to be another really good example. The principle behind an exhaustion gap is that the number of buyers has likely diminished and now sellers are in control. So more people are selling the stock than they are buying the stock. One of the other things it says is that it normally comes after several weeks or months of upward trend in the share price. So let's take a look at the next example. So this is BABA. And just to kind of go back a little bit, so let's move all the arrows and stuff out the way. According to Investopedia, it says that these exhaustion gaps normally happen after several weeks or months of an increase in the share price. So we see that here. All right, we had very nice rise, nearly a double in share price from, let's say, March to October. Now let's look at the notes here. Again, the exhaustion gap, it typically occurs as the beginning of a trend reversal. So the trend up until this exhaustion gap was in an uptrend, and then we see a gap down. So if we dig into the chart a little more, we can see that on November 2nd of 2020, price closed right here at this level. The following day, on November 3rd, price opened down here. So it closed at 310 and it opened near 286. So that's a big move down. One of the things to note as well is that this gap down happened 2 days before an earnings report. So if we look here at the very bottom, you see a little E on the bottom of the chart where my mouse is. That tells you that there's an earning report that day. So 2 days before earnings, there was a gap down, and that happened on higher than average volume. So again, if we look here at the volume bars, they're right around this level. And then all of a sudden, what do you see? A spike in volume. That spike in volume coincides with this gap down, and then an earnings report on November 5th. Essentially what happened was we created this gap, price came back a little bit, it did not fill this gap completely, and then it got sold off again. Then you had another gap down right here. This would actually be considered a breakaway gap at this point. So you can have a breakaway gap to the upside like we saw in AMD, or you can have a breakaway gap to the downside like we're seeing here in BABA. So this one, we can actually coin it as a breakaway. All right, so we'll do that here. So this one, the first gap was an exhaustion gap. And again, we know that now by looking at the price action and seeing what happened afterwards. You won't know immediately after, but you can get clues again by looking at these definitions, by looking at the volume and looking at the price action. And then again, you see at the bottom here, you have a bit higher than normal volume. And from here, if we fast forward in price action, because this was November of 2020 when it started to show signs of exhaustion. So again, just to revisit and go back, you had a strong uptrend, and then you started to find more sellers than buyers over here, and that created the exhaustion gap. The earnings call also accelerated the downside move. And now if we fast forward into time here, we can see what happened. We're now much, much lower. So from these highs of $310 as of the recording, we're now at $150. So the stock has lost 50% of its value from its highs when that exhaustion gap showed up. So really interesting stuff. And then we can see here, there was a couple gaps that did get filled. So we had a gap over here that got filled over here. So some of these gaps did come back and fill price action. But overall, this was a turning point in this chart where basically there was no more buyers and now it just became sellers. Now there's a lot of economic reasons to that, such as some of the China crackdowns that's been going on. So if you follow overall market and economy stuff, then you would have an idea that China is regulating harder on these big companies, and China doesn't want that competition from their private sector. So these are some of the factors behind it. And, we can see that since this gap, it's lost 50% of its value. So pretty amazing stuff. Another really awesome example. And so that's it for today. We're going to wrap up there. So some of the gaps that we covered were the common gaps, the breakaway gaps, runaway, and exhaustion gap. These are 4 types of gaps that you can keep an eye out when you're seeing price action. I encourage you to mark those on your chart as well as set alerts on those areas so that you can be alerted whenever price goes into those ranges again. And that could be a potential trade opportunity. Paying attention to these things can really give you some subtle clues as to what the next potential trend is going to be. All right, guys, hope you got some value from this. Thanks for watching.